All right, so I think we'll kick off, if that's all right with everyone. Um, uh, so our theme is the investment food chain, and what we're planning to discuss is recent developments and changes in the way investors have looked at financing private enterprise and the implications of that for the way in which private enterprise has been funded. So some sort of self-generating food chain, if you like. We're very privileged to have on our panel cutting-edge participants from key aspects of that investment food chain. First of all, John Powers, who is Chief Executive of Stanford Management Company, one of the opinion-leading university endowments in America, who've really made a difference to the way in which investments have been thought about. Stephen St. Leger from Cambridge Associates, the gold standard globally in terms of gatekeepers for investing in funds, gatekeepers to the large public service funds, etc. Sanjay Patel, international private equity head of Apollo, one of the world's top alternative investment managers with about $80 billion under management, very broadly diversified. Jonathan Kelly, head of global emerging markets fixed income at Fidelity, the largest money manager in the world. And Jonathan, in his fund, manages a mere 20 billion of the 3 trillion that Fidelity has under management, I believe. What I'd like to do is just ask the panelists to give a brief summary of what their organization does, how it fits into the investment continuum, if you like, and then we'll have some questions for the panel and then some questions from the audience. John, if I may start off with you.
Sure. Thank you, Osman, and it's a great pleasure to be here. We manage at the management company an endowment and related. PhD stands for push here, dummy.
That's great.
So I have my PhD from Stanford. We manage about 20 billion in assets on behalf of Stanford University, with the idea towards running them as a perpetuity, no time horizon end in sight. We pay out of that 20 billion roughly 5% a year for the purposes of operating the university. So we pay about $1 billion a year to the operating university, which comprises just about 25% of the budget of Stanford. So we're a very significant contributor to the ongoing ability of the university to operate. What do we do? We're basically a captive multi-asset class fund of funds. We invest primarily through third-party managers across a range of asset types, although increasingly we reserve the flexibility and ability to run some of those assets ourselves on a direct basis. How do we invest? Well, endowments not too long ago, say 20 plus years ago, typically ran a book that was 60% long equities in sort of blue chip American stocks and 40% fixed income. We've come a long way from that 60-40 allocation of almost entirely liquid securities. We're invested in private equity. We at Stanford were instrumental in a variety of ways, both as investors but as well as creators of intellectual content in building the venture capital business in the west coast of the U.S. We're invested in real estate, not only through REITs but through direct holding of real estate assets, commodities and natural resources, and hedge funds. So if you take all those things and bucket them together as alternatives and contrast the alternative percentage of our portfolio with the traditional long equity and fixed income percentage of our portfolio, we're about 73% alternatives. So the inmates have taken over the asylum there. We're heavily weighted towards alternatives. We're one of a number of types of institutions that form the backbone of institutional capital in the U.S. and in fact around the world. Endowments, foundations, public and private pension plans, sovereign wealth funds, relatively new players on the global capital allocation scene, and in some cases high net worth individuals significant enough to act as significant capital markets participants in their own right. So that's a quick introduction.
Thank you very much, John. Stephen, you have some slides. Cambridge Associates prezentasyonunu çıkarabilirsek lütfen. Pardon, Cambridge Associates'ı çıkarabilir miyiz? Stephen, I can give you a... Do you want to come up here so that you can have a look at the slides better? Or?
I can see them here, can't I?
Okay, great. I can give you something to
point.
The two arrows.
2 arrows for forward and backward. Okay. Good afternoon, ladies and gentlemen. It's a very great pleasure and honor to be here. Having escaped from grey skies of London, a greying population, and a greying economy. It's really good to be in a corner of Europe which has the outstanding economic success and strength that Turkey has currently. My mood was lifted almost as soon as I arrived here, a place which has low government debt to GDP, low budget deficits, and high growth. I can't remember what that felt like before in the rest of Europe. So at least part of Europe is working well. And so therefore it's doubly a pleasure to be here. If I can move this. Can we have the next? Do I point it? So you had a problem with the one button. I'm having a problem with another button. So it just goes to show.
A full panel of PhDs.
Exactly, right.
Thank you very much. That's on now. Okay, thank you. All right. So, sorry about that. Cambridge Associates, because it was founded in Cambridge, Massachusetts by 2 PhD students at Harvard in 1973. Harvard Endowment asked them to look over their portfolio and see if they had any bright ideas, and apparently they did. And that included starting to introduce alternatives that John's spoken about, so hedge funds and private equity and venture capital, which was pretty unheard of in those days. And they built a business from there. So historically, a lot of our client base was from the US. It was endowments, it was university related, it was charities, good causes, philharmonic orchestras, museums, etc. Since then, we've diversified a lot. So we now have offices around the world. London is the office that covers Greater Europe, including Russia and Eastern Europe and Turkey, and the Middle East. And then we have offices in the Far East as well, Singapore, Beijing, and Sydney. In terms of profile, I guess we pride ourselves on, like in real estate, it's location, location, location. So we believe that in investment advice and consulting, it's independence, independence, independence. And the independence is that we are fully independent. We're a private company. We're not an affiliate of any other financial supermarket, and therefore we're not directed to do this or that. We don't have someone coming in to change strategy or management from year to year. Secondly, we are charged with giving the best advice to our clients, and that means evaluating managers, such as the ones on my left here, in a truly unbiased, objective fashion. Unlike some, we do not take any commissions from anyone. We do not take any payments from anyone. The only people that pay us are our clients. if we do a decent job, that is, otherwise they fire us. So. And thirdly, research is very important to us, and our research is independent as well. So it's not directed to selling any particular products or any asset classes. We don't manage funds, and so we have no particular axe to grind. This is the map. We've already covered that. So you can see we have 4 offices in the States, including the head office in Boston. In terms of people, so we have, as you can see, just under 400 consulting staff, that is senior consultants and associate consultants. These are the people that are directly in the firing line giving our clients advice. But we do believe in having it backed up by a lot of research. So we have, as you can see, 273 research people, which is divided between researching managers of all types, so hedge funds, private equity, venture capital, but also long-only equity, long-only fixed income, and real estate and real assets. And then we do performance reporting for some, not all our clients, so we do monthly and quarterly performance reporting, so there's a big team that does that too. In terms of composition of clients, I guess the main thing to note here is it's pretty diversified. So colleges and universities and foundations were the bedrock originally, but it's spread out. So we do have non-endowed institutions, which could be company pension funds. Typically, they will look to us for some aspects that they find difficult to obtain from other advisors. And that's, I guess, mainly hedge funds, private equity, venture capital. And then private clients, these tend to be family offices of a certain size. In the London office, the client base is slightly skewed because we cover the Middle East. And so London distinguishes itself by having an abnormally, well, a disproportionate amount of quasi-government organizations, central banks, and sovereign wealth funds that are domiciled in the Middle East. In terms of the menu of services, they go from the very light touch at the left here, which is just someone will come to us with a project, maybe to benchmark their performance or to look at their alternative portfolio, to all the way to the right, which is, as they say, to use that horrible phrase, soup to nuts. We will do absolutely everything. All you have to do is meet with us on a regular basis and we explain what is happening. In terms of our philosophy, I guess it hasn't changed in spite of the ups and downs of the market. We do believe you do have to have a growth driver to your portfolio, and the only long-term growth driver to your portfolio is equities. And that's obviously very relevant to where we are today. However, we recognize that there can be rather turbulent times, and both market-wise and economy-wise, and therefore you always have to have 2 tail risk hedges in place. One against debt deflation, and that means you've got to have high-quality bonds to tide you over the bad periods, such as 08, 09. And at the other end, even though you may think we're going into debt deflation, you mustn't forget about the inflation hedges, because that can bubble up quite quickly and unexpectedly. So real assets serve as a hedge against unanticipated inflation. Our way of advising is actually twofold. So we advise on asset allocation, so we provide a structure for clients in terms of proportional weights in the different asset classes. And then once that is agreed, we monitor that, and we're very, very, very sticky about valuation. In other words, you have to flee asset classes that have become expensive, and you have to buy asset classes that have become cheap, even though behaviorally that feels like just the wrong thing to do at the time. So we're trying always to enforce the discipline, and our compass for asset allocation advice is always relative valuations. So that informs how we do the asset allocation, and then underneath that we have the manager evaluation and selection and monitoring. I think that's really more than enough for now, so I'll pass over to Sanjay. Thank you.
Stephen, thank you very much. Sanjay, over to you. Apollo şeyine çıkarabilirsek lütfen. And Stephen, if I can ask you to pass the baton over to Sanjay.
It's been passed. Good afternoon. Very pleased to be here, like all our other panelists, and looking forward to spending more time in Turkey based on everything we hear. So let's just I'll give you a 5-minute run through on Apollo. Apollo is a value-oriented, contrarian alternatives investor. So people like John at endowments and pension funds invest capital with us in various asset classes, and typically, as Stephen said, we work with consultants as they think about various investment alternatives for their customers. So that's the way the chain works. We actually have 105 billion of assets under management. Osman, we've grown since in the last 5 minutes, and actually partially as a result of an acquisition we did recently in the credit space. But we manage private equity, debt, which we call capital markets, and real estate. The value proposition and the differentiation of Apollo is that we have had a long-standing approach to investing through cycles, and especially during down cycles, especially at a time when there's dislocation in the world. And secondly, we are agnostic between investing between debt and equity. So we have had a history of being significant investors in credit over the last 20 years. And right now we have about 200 investment professionals, about 600 people at the firm. Our 4 businesses, essentially private equity, where we manage roughly 38 billion of capital. And that's a global business. We own, typically control of companies in this business. We're roughly 40 portfolio companies today. We have what I describe as capital markets, but a credit business, which is actually now our biggest business, which is roughly 56 billion. And finally, real estate, which is roughly 10 billion. Natural resources, which is increasingly a significant part of our private equity business, is something that is a new business for us. We've been long-standing investors in oil, gas, and metals, and we find it a very attractive place to invest capital. And we think this will be a business that will grow for us over the next 20 years. This simply says, it's a chart. One of our key tenets is that we run an integrated platform, what we call an integrated platform, where all the professionals of the firm, whether they be in private equity or capital markets, speak to each other. We think that the ownership of companies in our private equity business is a huge competitive advantage in terms of information on what's going on in the globe. A lot of our companies are global. For example, we have a very big company in Europe that is in the logistics business that happens to be a very has a big business in Turkey. So we tend to know what's going on in Turkey, even though we're not direct investors in Turkey today. But Siva Logistics, manages a lot of logistics chains in Turkey. So we tend to have quite a global view on what's happening in the world. And this is just a list of our 9 industry verticals that we invest. So we typically invest in pretty much anything other than healthcare and technology. You can't really read this, so I'll skip over it. But it basically says our returns have been very attractive over the last 20 years. We've managed to return about 39% per year, compounded over 20 years of investing. And the reason we put this chart up is it shows people the green shaded boxes are the periods over the last 20 years where there have been recessionary periods, 1990, 2000 to 2003, and recently 2008 onwards. And during this period, we've probably invested half the capital of our firm is being invested in these periods, which we think is a great time to invest. Investing tends to be a reasonably straightforward business. Typically, you want to buy low and sell high. The best times to buy low are in periods of recession. That tends to be the period where people don't invest a lot of capital because there's a fair amount of dislocation. But we think that's exactly the time to be actually putting capital to work. So there are four major themes that define today our investing strategy. Just want to briefly talk about them. The first is we think the banking system, the global financial system, is shrinking. And that means the banks in Europe in particular, which have gotten very large, have to reduce their balance sheets. The US banks have reduced their balance sheets. But the European banks have been global providers of credit, not just in Europe, but all over the world. And over the next decade, they are going to have to shrink to meet capital requirements. And that's creating a whole host of investment opportunities. The second is there is a shortage of illiquid capital. So endowments like the one John manages, or pension funds, or sovereigns are some of the few places in the world that can invest in illiquid assets. Most people want liquidity. Most people are pushing towards liquidity, which is driving down yields, which is something we may chat about. But we think that is a more dangerous place to be. So we think illiquid investing is a very, from a value point of view today, is very attractive. And we think a big premium can be taken out of investing on an illiquid basis. And finally, we've talked about the return destruction in traditional asset classes, but there's enormous amount of uncertainty in the world. And that's the backdrop against which we will have to invest for, we think, a fair number of years, including a lot of geopolitical risks. So what we tend to think about is we could go away and not do very much and play golf. The other choice is to do things that we think can create what we describe as alpha for our clients. And there's 5 things that we're spending time doing today. The first is distressed investing. It's something we've done for many years. Right now, there are great opportunities in specific parts, particularly in the US, where distress for control, it's a very specific form of investing in credit. We think it's a very attractive place to put capital. Europe, as I said, we think despite the fact that the macro environment is not particularly good, we think you have to be disciplined, but there are big opportunities to buy assets from the banks, and that's something that we're spending a lot of time doing. Emerging markets, we've talked about, obviously places like Turkey, India, Brazil. Despite some of these economies slowing, these are economies where the fiscal position of the countries is better. There's growth, and to the extent you can find value, which is tough, we think emerging markets are a place to put capital. And finally, commodities, which I mentioned, we think it's a very interesting time to invest in oil and gas and certain commodities. There are risks in that strategy, given what's going on globally, but we think it's interesting. And then finally, one of the things we try to look for in this environment is making investments in companies that are what I describe as non-correlated to what's going on globally. So insurance, for example, is an industry where people will continue to buy insurance whether or not countries are growing. So these are the themes that define how we invest, and we will invest over the next 5 years. Thanks.
Sanjay, thank you very much. Jonathan?
Great, thank you. Good afternoon. I'll say hello as the presentation is loading. My name is Jonathan Kelly, and I'm a fund manager at Fidelity Investments. I also co-run our global emerging market debt business. And it's certainly a pleasure to be here today. Turkey is one of the most important fixed income markets for global emerging market fixed income players, and that's something that I'd like to touch on a little bit today. As I mentioned, my firm is Fidelity Asset Management Company. We're a privately held firm based in Boston, but with locations all over the world. We are the largest mutual fund company in the US with over $1 trillion under management, and we have a number of retail and institutional investors, and we manage funds all over the world on behalf of our clients. Like some of my colleagues here on the panel, we have a global firm. We have approximately 400 research professionals in our US-based business, And for our sister company, which is our international company, that figure is about 300 investment professionals all over the world. So we're focused on both equity management and fixed income management principally. And what I'd like to talk about today, which is my specialty, is emerging market debt. And I'll keep this brief, but one of the questions that comes up is, what is emerging market debt? Where did it come from? How do you invest? And very briefly, the modern history, of course, the real history is that countries have been issuing bonds for centuries, and in some cases defaulting on them, some cases paying them. Our current market really began to reemerge in the early 1990s, and the predecessor was really the heavy bank lending that took place during the 1970s to sovereign countries. These were the so-called recycling of petrodollars, money that was made particularly from oil and gas in the Middle East, recycled through banks and lent to sovereigns all over the world. The 1980s witnessed a more difficult environment, both with U.S. monetary policy from Paul Volcker, lower commodity prices, which led to a lot of sovereign debt actually defaulting during this period. And in the early 90s, under something called the Brady Plan, which was named for the Secretary of Treasury at the time at the first Bush administration, a lot of these loans that had defaulted were restructured and turned into bonds. And this is the beginning in the early 90s of today's marketplace. As you can see, Fidelity opened our first open-ended mutual fund, and it was the first in the class open-ended mutual fund in 1993, called New Markets Income. And the market has continued to evolve since then. First, you had countries, instead of having restructured Brady bonds, issuing large amounts of debt in the Eurobond market. And then as these countries made great improvements, such as Turkey, you've seen corporate bond markets evolve, and you've seen these countries being able to borrow more and more in their own local currency, which is an important way for them to become better credits and deepen their own local capital markets. So when we talk about investing in emerging market today, we generally do it in one of three opportunity sets. And I apologize, there's a lot of numbers on this slide, but here are some of the key takeaways. The first category is investing in dollar-denominated sovereign bonds. And as you can see here, the market capitalization is a little over $500 billion for that opportunity set as defined by JP Morgan. It's very investable, and there are 49 countries worldwide, and Turkey is one of the most important countries there. As you can see here, the weight has fluctuated recently between 8 and 9% of that global EM debt benchmark. The second category is countries' local currency markets, such as you have here in Turkey. It's a much bigger market, nearly $1.5 trillion. The investability is somewhat varied. For example, two of the larger countries in the world, China and India, don't allow completely unfettered access to their local capital markets. So in some cases, the markets are quite liquid, such as here in Turkey, and in some cases, not very investable at all. Again, in Turkey's case, they're about 9% of this benchmark. And that brings us to the final opportunity set, which is corporate bonds, in this case denominated in dollars, somewhat less liquid, over 1,000 issuers as represented by the Bank of America Merrill Lynch indices. And you can see here, and this is one of the points that I wanted to make today at our presentation, is that Turkey's weight is actually fairly low, only 0.9%, which places them, as opposed to being fourth largest in the dollar market, 18th or so in the corporate bond market, which is, I think, a real opportunity, not only in the future for investors, but hopefully for Turkish companies as well to tap this market. If we look at the dollar-denominated side, as I mentioned, Turkey is the fourth largest country, with the top 10 countries comprising about 70% of this benchmark, even though there are 49 of them, so it's quite top-heavy. Today, about 65% of this index is investment grade, and you can see here there are two countries, Turkey being first and foremost, the Philippines being second, that we believe are already deserving of investment grade sovereign ratings that we think will actually happen next year. So if you take both Turkey and the Philippines together, the investment grade weighting for sovereign bonds will be about 80%, we believe, by the end of 2013. And the story of emerging market debt is one really of credit quality improvement. And what we've tried to do on this slide is show you the yield, which can be shown on the left-hand axis, yield to maturity, and on the right-hand side, the percentage of the index, which is investment grade. So in the early 90s and in the first part of the last decade, you saw double-digit yields, which has accounted for great total returns for investors over the period. But as the world got better and these countries got better, you're now looking at over 60% investment grade, and yields have come down to the point where they're now closer to 5% as opposed to double digits, which sadly means that a lot of the high return days are behind us in this category. One of the things that's kind of interesting is we show you here some of the yield curves. These are dollar-denominated yield curves for a number of countries in our index, not all of them. And what you can see visually is that a lot of them have collapsed on top of each other, in fact, yielding 2, 3, and 4%. And we've highlighted the Turkish yield curve. And what's happened in today's world is the search for yield continues, and emerging markets have become, ironically, sort of a flight to quality, is that there's really not a lot of exciting stuff going on in the major yield curves. Yields are low. It's not completely obvious from this slide, but the efficiency of the curves are high, so there's not a lot of arbitrage or security selection. So our takeaway in terms of how we look at the world and try and run money from this slide is twofold. Number one, from a sovereign standpoint, we focus our research on some of the more troubled names out there, Argentina, Venezuela, Ukraine, in terms of our own research efforts. And secondarily, among the good quality countries, of which Turkey is one, we increasingly focus on corporate bonds. So here we have the dollar-denominated sovereign curve for Turkey, and you can see some of the yields and the durations. The R-squared is fairly high, which means it's a fairly efficient curve. And what we're trying to do now is look at corporate debt as a way, looking at good quality companies to add value to a low-yielding, efficient world. Now, in the case of Turkey, I mentioned that the corporate bond universe is still fairly small and, in fact, has been dominated by bank issuance. So you can see here a number of the leading banks in Turkey, which we believe, for the most part, are very strong credits. İşbank, Garanti, Yapı Kredi, Akbank, have all issued in the last few years in the 5- and 10-year sector. And we've been involved in some of these issues and feel that they've offered good diversification and good increased yield opportunity for investors. And as I mentioned, we'd love to see more from the corporate sector going forward. The final opportunity set, just to touch on briefly, is local currency markets. And as I mentioned, this has been an important development for many countries, that they can increasingly fund themselves locally. So they don't have these asset liability mismatches between, say, dollars and euros and their own currency. And we just highlight Turkey. There are two main intellectual rationales for investing locally. Number one, higher nominal yields, as you can see here. These are just the sub-index data. You're yielding approximately 8% in Turkey in the local market, whereas its dollar markets yield about 4%. And some of the other examples in the countries here. The second intellectual rationale for looking at these local markets is the diversification benefits that come from local currency investing. And currencies themselves are inherently diversifying in the sense that for any currency pair, there's a winner and a loser for any cross or bilateral movements. So the opportunity to create a more diversified portfolio really can exist with these local markets. And here I just note some of the statistics for the Turkish market, which I'm sure that many of you will be aware of. The local yield curve in lira on the lower left. Turkey also has a TIPS market, an inflation linker market, which we find, broadly speaking, to be one of the most attractive sub-asset classes in global emerging market debt because, as Stephen mentioned earlier, one of the scenarios that we all worry about is the inflationary scenario. I'm not sure that Western central banks are too worried about it these days, but the fact is, over long periods of time, inflation can be one of the great enemies of investors. So TIPS markets, we think, can offer great opportunities for investors to protect themselves there. And not only does Turkey have that market, they've had it for a number of years. We're gratified to see positive real yields, which we don't see in our own U.S. market. And then finally, I think we heard earlier from the governor of the central bank, some of the monetary policy has been relatively controversial over the last year or two. We actually think the central bank has done a very good job in Turkey in terms of managing external deficits, the inflation picture, and most importantly, currency volatility, which the governor said is a key target of stability. So to sum up for the asset class, I've got the three categories here, and I won't bore you with all of these things, but in terms of local currency, which is in the middle, you see high yields, diversification, and for dollar-based investors, it's a way to diversify away from the dollar. For hard currency investors, we've seen a great track record of returns, improving credit quality and liquidity, but sadly low yields and high duration, which are the key risk factors going forward. And then finally, among corporate bonds, higher yields than sovereign, a continuing broadening of the market, lower liquidity, and then finally something I won't really touch on now unless we get questions, creditor protection can vary from country to country. And just as sort of a final selling point for the corporate market, you know, I'd note that year-to-date issuance in dollar corporates, not local currency, is almost $225 billion from around the globe. So there's a lot of money and there's a lot of opportunity for companies to issue, and we would certainly encourage more Turkish companies to do so. So thank you very much.
Jonathan, thank you for that most interesting presentation as well. A couple of questions, couple of themes that occurred to me that might be useful to flesh out. The development in the last 25 years of alternatives has been an interesting phenomenon for investors seeking returns, and also for corporations and governments seeking financing, both fixed income and equities in terms of companies. Some thoughts on how that alternative sector has emerged, you know, private equity, venture capital, and so on and so forth. John, if you can kick that off for us, maybe.
Sure. Well, if you go back historically to some of the antecedent institutions to a place like Stanford, in the UK, endowments until very recently could only pay out earned income, rents, cash flow from bonds, things like that. So there was no incentive to invest for total return, that is, invest in assets where ultimately you needed to dispose of the asset to realize your gain. That's been the case in the U.S. for some time now, and as the private equity industry emerged, really starting in the 60s, both the private equity business and the venture business and endowments with a perpetual time frame were natural participants to think long-term and to sacrifice liquidity in the interest of higher return by investing in these newly developed private equity and venture structures. So the endowment business has really grown up around this emergence of alternative investing. Hedge fund industry, again, less driven by the pure liquidity issues and liquidity premia associated with private equity and or with the corporate growth, market development, technology innovation themes fueled by venture capital, but they're really more financial engineering around extracting the upside of investments while finding ways to hedge out or mitigate the downsides. But again, the endowments and foundations have really partnered with the originators of these types of investment vehicles to their great return. We've gotten to the point now where all those asset classes are quite institutionalized in their own right. Some would argue beyond institutionalized and senescent. Private equity is bulging with capital. There's an active market of one private equity company selling a deal to another private equity company that ultimately feels like a shell game, that there's got to be a loser or two in the end. And I shouldn't pick on venture has got way more capital than a cottage industry of true innovation can afford. Most of the quote alpha associated with close quote associated with hedge funds can be purchased much more cheaply than 1.5 or 2 and 20 fee and carry structures. So, there's nothing sacred about these vehicles. They are vehicles that have to stand on their own legs, generate sufficient return to satisfy both the needs of the endowment to make payout, and also to offer a significant enough premium over easily available liquid alternatives to continue to be worth investing in. So I think part of what we're seeing right now And we're heavily invested in all these asset classes, so in spite of my negative comment, we're finding ways to put money to work. But all these asset classes are, in their various ways, really suffering from what was talked about earlier, which is the reduction of people willing to commit illiquid capital to work in fractured markets. So all these asset classes are under some pressure at the same time that there's some really interesting opportunities being created.
Thank you very much, John. Stephen, how has Cambridge Associates, let's say, resource base changed as the alternative sector came into greater force in the world's sort of investment investment themes?
You mean how much of our internal resources we devote to it?
Right. How much was it, I don't know, 10 years ago? How much is it now? How has that changed for Cambridge?
My sense is that it has not changed a lot.
Right.
Because that's always been an important part of what we have done, along with path-leading institutions such as Stanford, Harvard, Yale, and the other endowments. I guess the amount of institutional capital and other capital coming into alternatives, hedge funds and private equity, has just been so powerful up until, I don't know, let's say 2008, that we expanded with these asset classes, but not disproportionately so. I think obviously now the things are a little bit different, and the financial industry has a 100% record of flogging a good idea until it dies, really. And as long as there's a little bit of profit to be made out of it, you're going to invest that marginal dollar or Turkish lira or whatever. And I think, in a sense, we reached that point in the alternatives in the last few years. There's clearly in the hedge fund space, we can see from our clients, there's a lot of question marks, because unlike in the previous debacle of the financial markets, if you think back to the bursting of the TMT bubble in 2000, 2001, 2002, when hedge funds came out shining because they protected very well on the downside and they caught the upside as well. So they did exactly what they were supposed to do. And that encouraged the last final wave of adopters, institutional adopters, into alternatives. By the time 2008 rolled round, there was so much capital invested there that actually many hedge funds, if they were not top flight, found it very difficult to produce that kind of attractive downside protection and upside capture. And so I would say now that the flow has definitely plateaued, and that's probably a good thing as far as we're concerned, because we would like to see a higher rate of return come back if the capital base shrinks a bit.
Right. Thank you. Underlying the notion of investment is the notion of risk. How is it measured? How is it priced? How is it balanced between issuers and investors? In your view, and maybe Jonathan and Sanjay, you can take a crack of this, how has the measure of risk changed across the last 10, 15 years? Have new notions been incorporated into it, like in liquidity maybe? And how has the balance of risk and the measurement of risk changed in the last, let's say, decade and a half?
Let me take a crack at it. I'd say, I've been in the alternative or certainly private equity business since the mid-'80s, and there's been always a debate as to whether we are relative investors or absolute investors. And because obviously over the last 25 years, interest rates have changed, risk-free rates have changed. And I think some people take a view that which is correct, which is our business is correlated to the public markets, and in exchange for illiquidity, as long as private equity investors give people a premium, it could be 1,000 basis point premium to the public markets, that's a reasonable place, and that's a reasonable result. I think there's lots of sides to this debate. Right now, with interest rates at an all-time low, risk-free rates at an all-time low, I'd say we at Apollo don't think we should be relative value investors because we continue to think there's too much risk in the world. If you are in illiquid investments, you should command mid-20s rates of return. And so the spread to risk-free is very, very high. And frankly, it should be higher because the world is more complex, as opposed to saying, well, what's wrong with 15%? So we actually run our business with that frame in mind, and we think that there's still, in a very volatile world, given our investment strategy, good opportunities to make 25% rates of return for private equity, and we can find 3 to 4 billion of those opportunities each year. You then kind of go up and down the capital structure and say, there are 8% or 6% return opportunities, 6 to 10, 10 to 15, 15 to 20, and we do offer products at each of those levels of risk, and they're typically credit products. But we tend to think in absolute terms. And I think that's a reasonable way to think because the risk of a business, the fundamental risk of a business hasn't changed. A business still operates. Yes, interest rates may be low, therefore the cost of financing that business may be cheaper. However, the risk of doing business has gotten higher, frankly. So when you think of the actual underlying business that you're investing in, the world hasn't dramatically shifted over 20 years, and so we tend to price risk and securities, depending on where it is in the business, up and down the capital structure, and try to be absolute return investors in all of our businesses. And different people can take a different view, and obviously people run money for in different ways, and if you're illiquid, I think you should run it. We think that's a sensible way to run an illiquid business.
Sanjay, thank you very much. Jonathan, some points of view on
Yeah,
risk?
no, absolutely, Osman. I think that in the bond market, there's been a real rethink about risk measurement in the last decade or so. Whereas traditionally duration was a principal risk measure for bond managers, I think that particularly in the credit world, any measure that you can think of illiquidity is really replacing that. And I think that one factor that may be driving that is just the low interest rates and the QE, that there's so little in terms of the interest rate side. We now find a number of investment-grade credits that don't have any, that are denominated in dollars, that don't have any statistical significance in their movement relative to U.S. Treasuries. So we really think that the rethink from a risk management standpoint is focusing on illiquidity, bid-offer spread, and understanding how that can impact a portfolio. Certainly 2008 was an important reminder of that. And it's a new world in the public market, and it's a bit of a scary world because yields are low, issuance is quite high. Sanjay mentioned earlier that it's hard to get any real return without illiquidity, and I would second that notion. And for us in the public markets, to get involved, and we try and get involved in less liquid credits as a means to drive alpha. I think the key on our side is to be able to do so without leverage, because leverage and illiquidity in the public markets are a very dangerous combination. So I think that for people focused on these illiquidity premiums, which I don't know if David Swenson coined that phrase, but I think you either need to do it in an unhedged fashion, or in an unlevered fashion in the public markets, or in the private markets where you have naturally a longer investment horizon, as John and Sanjay just both spoke of.
I just comment that I think there are lots of people who don't see the return obligation as Apollo does. I think the emergence of vast pools of capital like sovereign wealth and like pensions with big inflows that don't have, in the near term at least, really significant liabilities to match against that, ultimately means that there are big providers of capital from sort of my side of the fence who just aren't expecting returns of the same caliber that Sanjay mentioned. So I think there is a dampening down of appetite for return on the part of some of the LPs, the limited partners, and that actually happens to fit very nicely with some of the the generational wealth transfer objectives of the big private equity funds, which might be going public, looking to generate a multiple off of fees instead of carry. That leads them towards a more cautious risk profile. So I think there is some shifting going on in the private equity world, and we're trying to continue to find those people who would adhere to the sort of standard for return that Sanjay alluded to, because I think we see the world in a very similar way relative to the underlying corporate risk.
I was chatting to a US institution last week in the US, and it was about what is the required long-term real rate of return. So for a lot of institutions, that's the benchmark that they're batting against. And traditionally, it's been something like, the assumption is that over the indefinite long term, if you have a properly structured portfolio, you should expect to make, correct me if I'm wrong, 8 to 9% real return. And he said to me, but, we don't really believe that anymore. So what should the number be, right? And I think that's the one element of the risk question. People are saying, well, what is the long-term rate of return we can expect? Because we need to recalibrate the risks in our portfolio to something which we can have a hope of achieving. We don't really believe we're going to make 9% real anymore. On the other hand, we have the short-term risk, right, which is that you have these now twice in 10 years drawdowns of 30 to 40% in your portfolios. And so while people feel they should be putting on the long-term position to get the real rate of return, they're terrified the trapdoor's going to open again, and there's going to be another nasty 12-month period when they're down 30. And that is, I think, partly what's attracting many of our client base towards fixed income world and away from equity, because people are gun shy after what's happened in the previous decade. So there's a disconnect between long-term risk and short-term risk, I'd say.
Thank you very much for that, Stephen. Let me open it up for questions from the audience. Sir.
My question is to Mr. Powers. Do you think for endowments, or for at least for you, alternatives going to stay alternatives as traditional investing comes back?
We've other than for purposes of responding to questions on a panel like this, we no longer think about them as alternatives. We think about a full range, a full smorgasbord of investment vehicles, and we can look at with a range of different structures, describing some as alternatives and some as non-alternative or traditional. Doesn't mean anything, or excuse me, or in any way guide our thinking currently. So each of the things sort of encompassed by this term alternative creates a different set of issues and problems for us. We think about them differently. In the case of venture, as I said, it's the superabundance of capital relative to the number of truly quality innovative ideas. In private equity, I'd say it's what happens when you don't have a 25-year declining rate environment at your back. So each one has its own set of dynamics that will create problems for some and opportunities for others as we look ahead. But we don't think of it as a monolithic block of things called alternatives. We abandoned that some time ago.
Go ahead.
Do you any international assets in your portfolio?
I should have mentioned that earlier. We do. Today we're about 40% international. We probably peaked just prior to 2008 at about maybe 43% international. The extent of financial chaos gave us the opportunity to get extraordinary returns from corporate credits in the biggest, safest U.S. corporations. We took advantage of that, and that moved us on a tactical basis a bit back towards the domestic. Moved us about 3% towards the domestic portfolio. That march towards broader internationalization continues. Our reference portfolio for equities, this is inclusive of both public and private equities, is the MSCI All Country World Index, and ultimately, given that areas like Turkey, with great economic dynamism, are underrepresented in the MSCI equity because of the lower percentage of the market cap of the GDP of the country that's captured in its market capitalization of its stock markets. We will ultimately, and this will take 10 to 15 years, we will move through the all country world index weights and towards something that's more broadly representative of economic dynamism in the equity portfolio. Now, there are other parts of the portfolio that to some extent are geography agnostic. If you're in some kind of arbitrage business that you're taking the spread between two similar or very similar securities that have pricing mismatches, and you're extracting that value gap there, that security may be a domestic security, maybe an international security. You're not tapping into local economic dynamism as you invest in that. So for some asset classes, we'll never have a geographic weighting. But for our equity-driven portfolio, we absolutely will. Just another example, in the case of natural resources, if oil price setting is on a global function, then you want to be where the oil is because that's where the oil is, not because you get some unique benefit out of owning Russian oil versus owning American oil. Oil's oil, the price is the price. So we don't think about geography the same way for every asset class, but for our fundamental equity exposure, we're going towards a place of being really broadly representative of global equity structure in the world.
Other questions? Okay, fine. A brief one, and then we need to move it on.
You mentioned that the share of Turkish corporate bonds in the global market is very low, less than 1%, I guess. What is missing? I mean, what should Turkish companies do to increase their share to take advantage of global capital markets?
Well, your statistics are correct that the weight for emerging market corporate bond indices, Turkey is a little less than 1%. And I think that, as recently as 2 or 3 years ago, that number was even smaller. Turkey has largely been a bank-financed market for corporations. You've long had a deep and sophisticated banking sector. And I imagine also cash flow is another source of funding for businesses. To be honest with you, I don't have a great historical answer other than the banks have presumably served this purpose well in Turkey in terms of funding companies. I think that for us, we look at it now that the banks are starting to come to the international capital markets and have done so, I think, successfully. And by that, I mean they've started to place more and more paper at good spreads, and their issues have done well, that I think it may begin to open the door for Turkish companies. I would say that in the public markets, the issuance size tends to be anywhere from, on the low end, maybe 150 million to 200 million would be a smaller issue in this market. And for the larger enterprises out there, they can be issuing well in excess of $1 billion in particular bond issues. So I know that there are a number of companies in Turkey that certainly have the capability to issue in those sizes. So I think that we'll see. The market is open to them, and I know that there are a number of good companies. So we always, as investors, like to see more choices, more opportunities. So we're hoping that more companies will get involved.
Maybe one more question from the back over there.
In Turkey, we have a problem in the capital markets in the sense that small investors do not trust the markets, and also the owners of small and medium-sized companies do not trust the government and the financial markets. They don't want to lose control of their company, etc. So, can you offer an innovative way of managing funds, attracting small investors? I mean, this is a principal agent problem. Where should we look at so that maybe we have a unique solution? Thank you.
It's a very good question. I think that, the funds exist today for investors, for small investors to invest in these issues. I think you're right in terms of probably the historical either distrust of government. Another impediment for some companies may be the disclosure that comes from being in the international capital markets, and they would just as soon not go through the disclosure process. And not only is there an initial disclosure process to register those bonds, but there's also the subsequent financial reporting that needs to take place. So for private companies, that can certainly be an incentive away from them wanting to do this. I think that the main advantage right now is that in a globalized world, there is this large pool of capital at relatively low rates that are chasing opportunities. So I think that from my perspective, this is an opportunity for corporations to get perhaps long-term funding for relatively low yields and in good size. But you're absolutely right to point out that there are some trust issues, and I think there may be some cultural issues to sort of being willing to jump into these international capital markets. But my sense is from the investor side, Turkey is well regarded, and the markets I think would welcome these companies if they themselves chose to take the plunge in terms of disclosure and issuance and all the issues that go along with that.
Just actually, the question you raise is an issue facing a lot of small and mid-sized companies in most countries, and including Europe, where the markets have tended to want bigger companies. Bigger companies can issue what I describe as public securities. So the opportunity to invest in mid-sized businesses, whether it be in debt or in some cases equity, tends to be afforded by capital that's very illiquid. And the question is, that's not really a great place for small investors. However, the people like us who are finding, for example, in emerging markets, in Asia, we're spending a lot of time looking and setting up vehicles to invest in mid-sized companies that need capital for acquisitions. It may not be equity, where they give up control, but it may be essentially a debt investment where you can help the company grow or build a plant, which the banks may not want to give, and they're too small to go to get it in the equity markets. So it's guys like us who are finding, and raising vehicles, and we go to our clients and talk about an investment strategy that's focused, let's say, I'm making this up, emerging markets, structured credit, where we'll go in Brazil, Turkey, India, and China, create a vehicle that will invest $25 million per investment in mid-sized companies that need to grow. So I think the themes like that are emerging, but again, they're very illiquid investment vehicles. They would have to be illiquid because these companies are small and illiquid themselves. But I think that's going to be an emerging theme over the next period of time.
Sanjay, thank you very much. Well, it only remains for me to thank our panel very much. I certainly learned a lot from the experience that you are kind enough to articulate and to share about how the investment food chain is shaped today and how each of you fit together in it and interact in it. So many thanks for a really enlightening discussion, and I'm surely grateful that you came all the way out here to share that with us. Thanks, guys.
Thanks.